Hey, this is Pete Birchler from Stock Market Alchemy Blogspot. I have not done a video update here for YouTube for a while, but I wanted to get one out here this weekend and update the U.S. stock market situation. The chart I'm going to spend some time on here is the Nasdaq, and this is the Nasdaq 100. The symbol is QQQ, so the major ETF used to trade the Nasdaq 100. This is a weekly chart. I'm going to go through a few time frames here. The take-home message, I believe, is that we could be at basically zeroing in on a very significant high in the stock market here. And I'm going to relate this back to a few other indexes and talk about the volatility index as well. But let's just get into the analysis here, QQQ. So we're seeing prices all the way back here into 2005 or so. And I'm just going to zoom in on prices here the last couple years. First thing to note is the MACD on the weekly time frame peaked at the beginning of the year this year. Saw a little divergence pattern going into March where we saw a significant correction in the tech stocks, and since then prices pushed back to a significant new high, and yet the MACD is well below the old highs. So we have a very pronounced divergence, and it's a divergence that is developed after an extreme MACD reading, so the most extreme reading on the chart in years, developed here at the beginning of the year. And then we saw pullback, and now we're seeing the divergence develop even more significantly. And I think the closest technical points on the chart compared to that would be this peak here in 2010 prior to that sharp correction, and possibly this period here in 2011 where we saw a significant peak in the MACD followed by some higher highs with lower MACD peaks. So just given the weekly time frame chart here, important to note that the oscillators are not making new highs with price here. Now zooming in on price action a bit and looking at some trend lines, this red trend line here connects the highs from April 2012 with the high here from earlier this year to create the upper boundary of a trend channel going back a couple years. And we could see after this pullback to the middle section of the trend channel, price has now come back and touched the upper trend channel, pulled back, is pushing up again and touching a second time. So anytime you're looking at a long-term channel like this, beware when price gets towards the upper channel. Prices will tend to consolidate or rebound at channel boundaries. Now moving into, actually I wanted to go back and look at the prior high of the bull market going back to 2007, and not a real dissimilar thing here in that coming off of a major corrective point there in 2006 in the Nasdaq, we saw a couple significant highs, and connecting those highs we saw this kind of blow off up above the trend channel, the upper boundary here, as the market peaked. And interestingly, we saw the Nasdaq making new highs into November of 2007, peaking later than the other indexes, Dow and S&P peaking in October. And even going back into 2011, where we saw a major correction, about 21% in the S&P 500 from May to October. The Nasdaq actually pushed to slightly higher highs there in July or August, I think late July of 2011, while the other indexes did not break that high. So there's some tendency of the Nasdaq to lead here, to continue to hold up while the other indexes are lagging, and we're actually seeing that again here. So that's just my take on the weekly time frame, suggesting that we be wary or cautious here. Now I'm going to move down into a daily time frame. And so on a daily time frame, it's more of the same. We can see off of this major oversold low in April, where I had pointed out on the blog that this day right here, April 15th, could very well be a bottom reversal day. And it was indeed that, and we saw prices to rally to new highs. As price moved up to new highs, I had suggested that possibly the easy money was made on this rally, and it looked questionable of whether all the other indexes were going to be able to successfully break out. Now the Dow and the S&P did manage to make modestly higher highs. The Russell 2000 did not successfully break out. It ran up for about 1 day above the spring highs and then reversed back down and has been trading below there ever since. So moving and looking into just the MACD again here for the multiple time frame setup, we're again at a point where prices move to a higher high here on QQQ, peaking at 97.63 on Friday, and the prior peak here in July was 97.51. So we're at a slightly higher high in QQQ, yet if we look at the MACD, it's cycled back down towards neutral and is at a much lower peak right now. So certainly it's possible prices continue to rally, but anytime we're seeing these breaks to newer highs, with the larger time frame also in a divergence, and now we have this daily time frame not matching prices moving to higher highs. Again, that's another flag, another divergence. And remember, divergence is, at least in my theory of market movement, and I think if you study technical analysis in any significant capacity, the major trend changes show a divergence develop before the trend change. So we don't typically see markets turn on peak readings in the technical indicators like MACD or RSI or momentum. We see the peak, then we see a period of consolidation followed by a more extreme price but a lesser extreme in the technical analysis. And in my opinion, from studying at least real money gauges of sentiment, I believe that occurs in real money sentiment as well. I think we see it show up in survey type sentiment at sometimes, though oftentimes at the true price peak, there may be some dumb money sentiment measures that record their most extreme reading at the most extreme price reading. But in any case, what we're talking about right here is this tendency, just studying price itself and nothing else, for there to be divergences that precede a trend change. And so now we're seeing that in 2 time frames. And what I'm going to do is dial down here into the hourly chart of QQQ and just look for a minute here. So this is going back a couple months now. Here's back the beginning of June, here's the beginning of July, here's the beginning of August. And what we can see is on Friday the MACD reached a relative extreme, if you at least look at the levels of the MACD on the chart, which doesn't necessarily mean the trend is over, though oftentimes extremes like this slightly precede at least periods of consolidation. And so what I'm looking at here is potentially, given the weekly time frame divergence, the daily time frame divergence, is if we see some consolidation or continued rise a little bit followed by consolidation and then a higher high where we see a lower peak on the MACD, and we end up seeing some type of divergence pattern on the MACD while price is making a higher high, then that would be the type of setup where we would now have 3 time frames in a divergence. We would have weekly, daily, and hourly, and we may be moving into that point where multiple time frames are peaking in price, and the opportunity there for the trader who's willing to trade counter to the trend of the market and who is willing to scale out of the trade, trade in multiple units, and exit on partially on various time frames, is that the possibility exists that we get a quality setup to, let's say, short here off an hourly chart, and when you exit or when you enter that position, you go in with the plan of exiting part of the position at some profit target, or such as, say, a fill of an unfilled gap or something like that. So say we get a divergence pattern, we could have an initial profit target coming back towards these these gap levels here, or you could simply just have, an objective indicator, MACD coming down below the 0 line and crossing back up. That would be a sensible type of a buy signal, something like that. But you only exit part of the position, either half or a third of the position, and you just maintain the stop on the rest of the position above the price extreme, with then the plan of moving to a higher time frame chart and just using the same methodology. So let's say we did get a setup in that hourly chart and we saw price start to pull back into these levels. Then we would want to maintain the stop there and wait for the daily chart to come down and give some type of a buy signal like this prior to exiting the next portion of the trade. And you could possibly even extend that into a weekly time frame, though personally for my trading style I would not wait for the weekly time frame to get oversold and start to cross back up. If the weekly time frame was oversold on a MACD, and let's just move out to a weekly chart. So let's say we were to a point like like this in 2011, where the weekly MACD was oversold. I wouldn't wait for it to cross back up to exit. I would be now looking at a daily time frame for some type of divergence pattern to exit the position off of that time frame, rather than wait for the inevitably sharp and large, relatively significant percentage move in that stock or fund before exiting. So just talking about some practical trade ideas here, because this could be a very significant trade opportunity. Additionally, just going back to the trend line situation again, and if we can go back here to let's go back to the 2007 bull market top. Once we saw, we had this high and this high connected, and we saw price break that, it didn't peak at the first touch of that trend line. We actually saw a pullback or consolidation, and then a move to a higher high, which, if we were looking at a daily time frame chart, would have showed a daily MACD divergence at that level. And that was actually the better final high. So we don't necessarily expect the peak to occur right when price initially breaks the trend channel to the upside. And following that same type of logic here, we have our trend channel that I already pointed out, going back from 2012 to 2014. We have the first really touch or break of that trend channel here in July. Then we have a small pullback, and now here we are running up into the trend channel again, and it appears we're going to get that daily time frame MACD divergence, in this case also with a weekly. And just in my experience with studying tops relative to trend channels, and if you search my blog, you can go back and look at some things I've posted related to the gold market top in 2011, and even highlighting the oil market top in 2008, and go back and look at some of that analysis of the trend lines or channels at significant price peaks, and you'll see the same type of thing. So that's just another factor here. I would say adds weight to the typical topping pattern on these time frames. Now, what I want to point out here is move to a chart of the the VIX and the VXN, which is the Nasdaq 100 Volatility Index. And one thing I point out repeatedly on Volatility Index is again the the divergence theory relative to market activity, in that the typical corrections or declines in stock prices are typically preceded by a period of divergence or non-confirmation with the VIX. So let me move back to the QQQ. So the normal pattern is for as stock prices are going up, and let's just use this period here in February, and let's say QQQ moved up from February 5th up here to March 7th in QQQ, and let's go look at that period in the VIX here, and I don't even remember exactly what it looked like, but here's the February 5th price in the VIXN, and what we're seeing is that the volatility is high while the price is low. So there's an inverse relationship. And then as prices in the stock rose from February to March, we see the VIX decline here from February into March. But we actually saw the low point in the VIXN here on February 28th, and then when price peak that I just showed you on March 7th was here. So while prices were making slightly higher highs, we were seeing the seeing the VIXN not follow its typical pattern and make lower lows. We saw a similar thing here. Let's move to QQQ. Price moved up to July 24th in QQQ, and given the normal relationship of the VIX, we would expect the VIX to be moving down, the VIXN, and yet we saw the VIXN make its low here on July 3rd, and then here on July 24th, again, it was at a higher bottom, so it did not confirm that continued trend in price. And we're seeing the same thing occur right now, but on a little bit larger scale. So again, if we look at QQQ and we say, here's the peak, price peak here on July 24th, and we're seeing prices make a slightly higher high now. When we look at the VIXN, it's at an interesting spot because it basically matched or made a slightly lower low than the VIXN level here from July, yet it is still above by a significant margin where it made its low in the VIXN in June. So I do view this as a divergence or a non-confirmation pattern in the volatility index, which this volatility index is for QQQ. It is for that fund. So the volatility and the price extremes or trend are still not in a period of matching trend right now, given their typical relationships. And I view that as another relationship pointing possibly here to caution or just creating a setup of the underlying market sentiment, in this case real money sentiment from the option market, that suggests we could be moving into a period of more extensive topping here. Last thing I'm going to point out here is some of the other indexes as far as non-confirmation. So we have the QQQ, which is the large cap Nasdaq stocks, the tech stocks. They're at a new high, and yet none of the other major indexes that I follow are at new highs. So let's move over to S&P 500 here. So the S&P 500 is still a couple percent. It peaked at 1991, and we're trading here 1956. So 35 points, close to 2% below the high. That's significant. If you look at the New York Stock Exchange, more of the same. We're at about 10,800 with a peak back here at 11,100. So it's close to 300 points or nearly 3% below its prior high. So that is not confirming the trend in the Nasdaq 100. Let's move into the Russell 2000 here, and we see the Russell being the weakest of the major indexes, having just double topped in July relative to its spring peak, and it's trading now at 113.40 off of a peak of 121. So it's $7.50 off the high, maybe 6% or so off the high. So a significant, still off of the high by a significant margin. And the up in this bull market up until March of 2014, the Russell was really the big winner. So we're now seeing the small caps, which were the biggest gainer in the bull market, now starting to lag, and could mean a couple things. The obvious thing here, which I'm suggesting given some of the other technical analysis, is this could be a kind of a time-consuming topping process occurring here over the last 6 months to 9 months in the market. The other option is that this is somewhat of a major consolidation period to be followed by a very significant continuation in the bull market. I would rate that as a lower probability for sure, but certainly one we can consider. Another interesting thing here on the Russell 2000 is that prices are just hovering above a trend line now with 4 touch points. And let me just hide some of the drawings here and look at this. Well, I'll just put this drawing on here so you can see, but if we have a trend line going back from the bear market low in 2009 to the low in 2011 to the low in 2012, prices have touched and just paused at that trend line right now, slightly rebounding off of it. So that gives us a 4th touch of the trend line. In my opinion, if we see price break down below both this recent touch point here, just from August, as well as this touch point here from April, that would probably be a legitimate breach of this trend line, and possibly kind of a confirming nail in the coffin that this trend is done, and at least that we're going to see a correction of this major run-up over the last year and a half or so that we saw here, going back to the November and 2012 low. Last thing I want to point out here, a couple of charts we'll look at. This one is the banking index, and on freestockcharts.com the symbol is DJUSBK, Dow Jones US Banks Index. I believe on stockcharts.com, if you do $BKX, it'll give you a similar index. If going back to, well, let's just take a weekly chart back to 2007, 2008, and look at the last bull market top, and look at this here. Obviously, anybody who's followed the markets understood that the banks got hammered and financials really led the way down in the last bear market. But financials are generally considered to be, a leading sector of the market, and as such, when the broad markets are making continued, in this case, higher highs, and we see the banking stocks not making higher highs, that should be a flag to us. What's going on here? Why are the financials not leading? And while I'm not an economist and don't really value too much speculation in terms of the why of market action, I feel like successful traders and even market analysts, you kind of go with what you see, and you learn that the why typically only becomes apparent after the fact. And if you want to get in at good opportunities, you just have to recognize what's going on and not get caught up in the why and wait for the news to prove it to you. So, point being here, going back to the last bull market top, we saw banks peak in February of 2007, and let's go back here. The broad stock market, so the S&P 500, the Dow, peaked October 11th, 2007. So this week right here, and we saw banks at a much lower low, already having broken a prior support level. And the Nasdaq actually continued and topped in early November. So the Nasdaq was actually topping as banks were way below their bull market high. So let's fast forward here, come back to current time frame. We see that banks peaked back in March, and here we are in August, and so we're about 5 months or so removed. And while the S&P and the Dow still haven't made new highs, the Nasdaq is making a new highs. is making a new high, and banks are, if we move in now to kind of a daily chart and look at it, the banks again, even compared to their July 3rd high, notice they did not confirm new highs in all the other indexes other than the Russell 2000, as the Nasdaq was peaking on July 24th, S&P 500, the Dow peaking in a similar time frame there. The banks did not move above the July 3rd high while the other indexes were, and now here we've seen just a muted few-day rally, even as the Nasdaq is back at a new all-time high, and the other indexes are just a couple percent above or below their highs. So here we have financials kind of showing some lag to the in the market again. We're starting to lead to the downside, and just from a chart pattern standpoint here on the daily time frame, we have a potential head and shoulders topping type of pattern, and I would say this is a pretty nice one. Very flat neckline. The right shoulder here exceeds the left shoulder, which personally I like that development in the head and shoulders pattern, and we're seeing this shoulder develop with significant non-confirmations with other indexes. So there's a lot of things here that would suggest if we do see a break of this trend line or this support level, the neckline of the pattern, that would be significant, and in my mind that would correspond roughly with, if we go back to the weekly chart, back to prior bull market peak, I would view that similar to the break of the March 2007 low, in that we had a non-confirmation and we had a break of support while the other indexes were still holding that support level. And so let's be alert for that here in the financials. And the last thing I want to look at is just move to housing as well, and kind of seeing more of the same, in that on a weekly chart we saw housing stocks peak in April of 2006, so peaked way before the market, a year and a half before stocks in general peaked. And as the broad market peaked in October of 2011, we saw housing stocks just trading down around 23 level, off of a peak of 46, so they were already 50% down in the last by the peak of the last bull market in the broad indexes. So here in XHB, which is the Spiders Home Builders ETF, similar to the financials, we saw a peak back in February, a failure to confirm new highs in July, and again a failure to even be close to new highs here as we are rebounding, and Nasdaq is at a new all-time high, and S&P and the Dow are just a couple percent off their highs. We're in excess of 10%, probably 12% or 13% off of the bull market highs here in the housing stocks as well. So whether or not on a macroeconomic scale, all of the problems with housing and banks and all of that stuff really ran their course in the last bear market, I'm sure is debatable, and it doesn't really matter. I just think inferring from this may suggest that if some of those same underlying credit type of problems or drivers are at play economically and in the the monetary system and that type of thing, that we are seeing a similar leading of financials and housing to the downside relative to the broad market, which again here I would suggest is probably not a great sign for stocks moving forward. Reality is, if we're getting to a peak, a significant peak in a bull market, and you're an investor, or you're holding a significant exposure of stocks, what do? Are you ever going to get the top right? And I don't have a great answer for you for that. I guess that's why you pay portfolio managers to rotate things and rebalance with bonds and everything. But I think that, in my opinion, it appears that we may be at a situation where both bonds and stocks are going to fall from these levels. And I would just, personally, if you completely manage your own funds, or you at least just have interest of my opinion or whatever, you have some input on that. I don't think you can go that wrong exiting part into extreme market strength. So after the market's been going up, and then you're seeing divergences develop, but they're still kind of making higher highs while those divergences play out. Just from my experience, you're very likely to see prices pull back to, even if they continue a bit higher from where you exited, often those gains will be given back and then some, at least a little bit, and give you another opportunity where you now have a reverse sentiment extreme to more confidently, as a contrarian, go back into the market. And so that would be my suggestion here. There's certainly, when you start looking at some of these charts, you could say that, hey, it looks kind of like home builders have pulled back here and they might be due to move up. Yet when you put that in the context of a broad market that's still rising, this might not so much be an indication that they're oversold, but be an indication that the market as a whole, the economy as a whole, that this is a leading indication of much more downside to come in the market. So take this, use it as you will. Again, this is just analysis, this is just information, this is just my opinion. As a trader or investor, you need to have some objective way to take information, to take data, to take analysis, and then make actual decisions off of that in terms of trading. So never just take this information and then not have some objective plan with contingencies as far as if that plan is if it works out according to that analysis, and if it works out maybe 180 degrees opposite to that analysis. You need to have contingencies for all things. So if you sell out of the market here and then the market rallies to new highs, what is the plan there? You need to think through all of that stuff. And if you don't have a good plan, maybe you just you let whoever's managing that money, if somebody else manage it, use their expertise. But the reality is, even the big funds and the smart guys, they get hammered in bear markets. So I think fortune favors the bold at times like these, personally, and might not be a mistake just to not get too bearish and start really trying to short things here, but just get more conservative. Just move into to cash, move into very short-term treasury type of things that you may still be invested. You may be able to just within, even if you have mutual funds, maybe you can just maybe even without any expense, rotate to a different fund in the same fund family of things you already hold, and just say, okay, I'm just going to move out of stocks and get into something that's safer, that's not focused on profit, it's just focused on maintaining capital here, and then wait for a new very negative sentiment extreme to develop before considering putting that money back at play in the market. So those are just again further ideas of possibly steps one could take here as an investor or a trader. So if there are any questions regarding this, leave a comment on the blog or even here on YouTube. If you have specific stocks or anything you want to look at, you can leave those comments as well. And I'll try and do some analysis on those either on the blog or here on YouTube. So hope everybody's doing well. I hope this is beneficial to your trading and to your planning of your investments. If there's any other way I could help, any other information that you guys out there listening to this you would like, then just get in contact with me through one of those avenues. With that, have a great day. All the best to your trading.